Thank God it's Friday. It's the final one for the week. Welcome to the Friday edition of Business Morning, coming to you live on Channels Television. I'm Ini John Mekwa. For the next 55 minutes, we're here, and it's going to be an interesting time, beginning with oil prices. It was mixed today as China's COVID-19 lockdowns weighed on the outlook for crude demand. Although supply disruption fares as Western sanctions curb crude and products export from Russia underpin prices. Brent crude futures rose by 15 cents to $107.74 a barrel. That's after it gained more than 2% in the previous session. The front month June contract expires later on today. The more active July contract rose 26 cents to $107.52 a barrel. U.S. West Texas Intermediate crude dipped 3 cents to $105.33 a barrel after settling 3.3% higher yesterday. Both contracts are set to close the week higher, with WTI on track to post 5 straight months of gains, buoyed by the increased likelihood that Germany will join other European Union member states in an embargo on Russian oil. Steel on oil prices have been volatile as Beijing has shown no sign of easing lockdown measures despite the impact on its economy and global supply chains. Now, on the supply side, OPEC Plus is likely to stick to its existing deal and agree another small output increase for June when it meets on the 5th. That's sometime next week or so. Well, 6 sources from the producer group have already revealed this. And still on the oil space in Nigeria, now French oil giant Total Energies says it will put up for sale its minority stake in a Nigerian oil joint venture. Its chief executive officer mentioned this in a conference call that the multinational oil company plans to offload 10% interest in the firm that holds 20 onshore and shallow water permits in the country. The announcement of Total Energies' exit after operating in Nigeria's oil market for over 60 years comes as its major counterparts, Shell and Exxon, already in the process of leaving the onshore fields of Africa's largest crude producer, and that is Nigeria. Away from the oil space now, one of the leading brands of telecommunications, MTN Nigeria Communications PLC, has announced a dividend of 13 naira 50 kobo for its shareholders. The chairman of MTN, Mr. Ernest Ndukwe, made this known at Ikoyi during its 2022 annual general meeting. Mr. Ndukwe says the COVID-19 pandemic provided an opportunity for MTN to push its business to the public and will continue to introduce more innovations to serve its customers better.
MTN Nigeria Communications PLC holds its 2022 annual general meeting at the rooftop event hall, MTN Plaza, Falomo, Ikoyi, Lagos.
Shareholders holding
only a limited number of shareholders are attending physically, with others joining virtually to deliberate on the financial statement for the year ended December 31st, 2021, the director's report, and the expected dividend payout.
The total dividend for the year ended 31st December 2021 to 13 naira 12 kobo, subject to withholding tax, be and is hereby approved.
They give MTN a pat on the back for the growth recorded in the past year.
MTN have done well as a company, communication where people bond their credit and speak, call, one end to the other than by data or voice, so basically they have done very well.
Mobile data, digital subscribers, data usage and population coverage also saw significant growth for the year under review, with subscriber numbers taking the lead. The revenue, capital expenditure and adjusted free cash flow also had their share of high performance. Other matters attended to include the re-election of directors and the company's audit committee. There's more good news for MTN customers with regards to the integration of the 5G network.
We will continue to innovate in order to make sure that our people continue to enjoy good services, and they'll vote by patronizing our services.
We continue to execute on our promise to deliver first world top-class technology and an experience to Nigerians and to our customers. We are not perfect, but we are always striving to get better, and we will deliver good quality services, including the launch of 5G in H2 2022.
After 20 years of connecting 68.5 million Nigerians, MTN Nigeria Communications is even more determined to lead digital solutions for Africa's progress by 2025.
And latest CBN money and credit data shows that credit to the government rose by 3 trillion naira, that's 22.5% quarter on quarter, to 16.3 trillion naira. In the first quarter of 2022, it went from 13.3 trillion, which that was for the fourth quarter of 2021. Now, this indicates that credit to the government dominated 4.2 trillion naira, that's 8.6% quarter-on-quarter increase in the economy. Well, to help us understand the implication of this, we have Mr. Ayodije Ebo, who is the Managing Director, Optimus by AfroInvest. Good morning, Mr. Ebo. Thank you so much for joining us.
Good morning, and thanks for having me.
So what's the implication of this increased credits to the government? What does it mean? What's the implication?
Okay, thanks. I think I would first start by explaining what the credit to the public sector means. It means that we have the financial services and the populace, or I would say investors, are borrowing money to the government. So there's an increase in the amount of money that is being lent to the government. So when you see that increase, it means by implication, there would be reduced availability of liquidity to the private sector. So you would see that, for instance, in the last earlier this year or the first quarter, we saw a lot of commercial paper issuances. This is a form of credit to the private sector, which helps to boost the available funding within that space, able to also support their businesses, both short-term obligations, especially using commercial paper, and when you for the long-term obligations using bonds, they are also able to expand their businesses. So what we would see is that it's like an opportunity cost. So the more you see that increase in borrowing, that credit to the public sector, it's in quotes, like crowding out the private sector, because it reduces the amount of money that will be available for lending to the private sector. When you look at most of these debt instruments that are issued, investors lend to the private sector. But because of that increase in issuances that we've been seeing from the government angle, especially looking at the major gap that we're seeing in the budget this year, initial projection for budget deficit was around 6.3 trillion, but has been increased to about 7.5 trillion. And looking at what government has raised so far, I think government has been able to raise about 2 trillion from both treasury bills and bonds so far this year. And we can still see that there's that gap. And given also the expected shortage from oil revenue, which had been initially projected at 3.3 trillion, it means that the budget deficit would increase. So the government is keen to fill that gap, and there will be need for them to be able to increase the amount of money they need to fund, and by implication, that would increase the credit to the public sector, because financial services will pack funds to invest in those instruments, and also even the private sector will also pack funds to invest in those instruments. And as a result, it will leave limited funds for development in the private sector.
Yeah, well, so it's costing development or liquidity to the private sector. But I guess if the public sector uses this fund for infrastructural development, then, it will still feed back into the private sector.
Yes, I think that's a very, very insightful statement. But, when you look at the reality of what is happening, especially in 2022, if you benchmark the actual revenue as a proportion of even debt service is almost 100%. So it means that most of the funding are going to even non-recurrent debt expenditure. So in terms of personnel, services, and also the expenses to run the ministry, departments, and agencies. So before you now get to the capital expenditure, which has been projected to about 4.2 trillion. So most of this funding may not be going into the productive sector. So the probability or the potential to recoup income for you to be able to pay in the future is limited. And another implication that is also concerning is that the more we continue to borrow, the more we also increase that debt service. And as a result, it's really going to impact on the efficiency and the effectiveness of the budget as we progress. So if based on projection, it's almost 100% of our actual revenue, not projected revenue now, is being used to service the debt. And we continue to borrow, it means that it will surpass 100%. And as a result, it means that we'll just be working to service. So government will be projecting revenue that will be collected, will just be used to service debt. Then there will now be a need to borrow more. So I think the implication or what needs to be done so that we don't continue to focus more on the problem is that there's a need for us to tell ourselves the truth and face reality. There's a need to bring down costs. This we cannot continue to. This cost is not sustainable. Both the non-current, especially the non-current debt, non-current expenditure. Yes, there's nothing we can do about the debt servicing because we have already incurred that particular cost and we need to service our obligation. But the non-current debt needs to, there needs to be a reduction in that if we are unable to grow our revenue. Yes, like it's always, the minister have always been emphasizing that what we have is a revenue challenge. And I would say that just like when you have a business, if you're unable to grow your revenue in the short term, then the best thing for you to do is to reduce your costs so that you don't continue to bleed. You need to stop the bleeding first, and you see how you want to channel more effort in growing your revenue. And once you're able to achieve that, or you are on the road to achieving that, then you can begin to increase your cost. I think these are some of the major reality that we need to face, and we need to tell ourselves the truth so that things doesn't go from bad to worse.
Okay, so when you say that, one thing that comes to my mind is what we've talked about on this show a couple of times, cutting the cost of governance. Would that be the only way? And even with that, really, in reality, we've seen government come out to say, oh, there's been this number of ghost workers, have been discovered. We don't know how much more is still in existence. But when we talk about reducing the bleeding, and when we look at the area of cutting the cost of governance, how do you think that can be approached in the short term?
Okay, thanks. I think the first thing is to try to harmonize the spending within the parastatal. So I won't quickly go into downsizing. They need to harmonize the spending and also reduce a lot of spending. So you see traveling needs to be cut because we can't afford it at this point in time. We're in a crisis. We can't afford it. It needs to be cut. And some major spendings also needs to be reduced. And I think there may also be need to intensify effort in terms of the biometrics to ensure that the ghost workers are reduced to a minimal level. So that will also save us some fund, and we'll leave more on the table. So I think by and large, it's more about the government has access to the cost. They know those that we can still defer. So we're not saying they shouldn't spend, but we can still defer, because looking at the projected recurrent non-debt expenditure is about 6.8 trillion. So if you look at it in this way, it means that in terms of our OPEX, using the company and the country and putting it into a perspective of a company, to run our country we are spending about 6.8 trillion naira for less than, when you look at the government, the number of people employed in the government, you would see that it's less than, I don't have the correct figure, but I know it's less than 1 million. So it means that we are spending about 30 to 40% of our total budget on that 1 million. So it means the cost of policy is very expensive, because government is there for them to create the enable environment, to create policies that will foster growth for the private sector. So if the cost of creating this policy, creating this environment is significantly higher than a capital expenditure of about 4.8 trillion, that would impact on the over 150 million and make businesses doing business, and also make cost of doing business very, very low. Then if there's a mismatch, there needs to be a review to that particular cost, because it's like you're over trading. The cost of providing the services is significantly higher than the potential return that you will get at the end of the day.
It will be really interesting if we can really get this picture out there. I mean, because for a normal business person, there's no way the cost of you running a business would be more than your revenue, you know, or more than your profit. I mean, you just will not be in existence. And I guess that's why we keep hearing and talking about borrowings and the debt stock and all that. But I mean, just before we let you go, let's look at the other side, which is the revenue side. Unfortunately, even, I mean, the oil, IMF just talked about emerging economies and oil-producing economies making the most of this time with the surge in oil prices. Unfortunately, we cannot make the most of that because we're not even able to meet up with the quota that OPEC has given us. And even when we're talking about diversifying the economy, you know, we're not even doing so much, that much good when in our non-oil exports. So I just wonder how we can move up, or at least shore up our revenue, even if it's in the short term.
Thanks. And when you look at the revenue, you have the oil and the non-oil. So the oil has been projected to about 3.2 trillion. But we're all aware of the oil theft that is going on, and also the reduced investment. Earlier in your program, you also highlighted Total Energy trying to pull out. So if investment is currently being reduced, it means that our production would also be reduced. We are not benefiting from this, and it's what it is to declare like an emergency situation to stop the oil theft within that space, so that we have more. Yes, we may not have statistics. Some are saying 80%, 50% of our revenue. So imagine that about 1.5 trillion is being stolen. And looking at it from the other hand, with the increase in oil prices, our petrol subsidy has increased to close to about 4 trillion. And when you look at what is also being spent, what is also being consumed in Nigeria, it may not be up to half of what we are paying subsidy on. It means we are also paying subsidy on for neighboring countries. So these are some of the major areas that you can even reduce revenue, you can even save costs, and you have more for productive sectors. So I believe that the fiscal authorities are up to the task. They need to look at this and for them to be able to fund this. And I would also like to emphasize, with the current structure that or the infra code that they've put in place, believe that if that also kicks in, it's also going to reduce the burden on the federal government, because most of these projects will be handled by the private sector, and it will reduce the bureaucracy that we would see. And more of, you see, like the Apapa to Ojota, that Dangote used some of the tax credit to fund that. Then we should begin to see more of that, because that also reduces the leakages. Instead of paying the tax to the government, and government also now try to release that fund, you also reduce that leakages, and also the cost of even those projects may also be minimal compared to when you have government handle some of those projects.
All right, Mr. Ayodele, we do know that the government is listening. We just hope to see more results from all the talks we've been having. Mr. Ayodele is the Managing Director of Optimus by AfriInvest. Thank you for sharing your thoughts with us. Do have a great weekend.
Always. Thank you.
We'll take a break now. When we come back, we'll look through the gender lens for investment opportunities and strategies. It's on Business Morning on Channels Television. You're welcome back. Well, gender lens investing, GLI, is a strategy to investing that takes into consideration gender-based factors across investment process to advance. It's been described as an impact investment strategy which deliberately integrates gender analysis into investment analysis decision-making. Well, we have to help us unbundle this and see how Nigeria is doing with that. Tokunbo Ishmael, she's a principal partner at Alethea IDF. She dissects, beg your pardon, the strategy in Africa and Nigeria. Hi, good morning. Good to see you, Tokunbo.
Good morning. How are you doing?
Doing good. Doing good. So how popular is this GLI in Nigeria?
Not very. Increasingly, people are becoming more aware of gender lens investing. Alethea Capital, which is a fund manager based out of Lagos, has invested in a number of inclusive strategies such as financial inclusion, energy inclusion, which people are more familiar with. And recently we closed over $100 million in funding to drive into gender lens investing, which is a strategy where, as you said, you consider gender-based factors to create value within businesses and to create opportunity and to close the gap on funding that is not enabling female founders and businesses that actually have an impact on women to secure funding.
So these days, it seems when we talk about gender equality, gender investing, you know, it's all about women. Is that it? Is that all there is to this gender thing?
You know, it's funny because just the other day I was saying to somebody, since when did the term gender just mean women? No, that's not all it is. However, let me share a couple of facts. Historically, most businesses have been run by the same type of people, same type of thinking, group thinking has come into it, and particularly historically, that has meant that it has been men in suits. What the research has shown is that when you have greater diversity from ownership into the boardroom, into the businesses, then you begin to have better decision-making. You begin to have better corporate governance. And I'm sure we could dedicate a whole show to talking about the effects of poor corporate governance. But also just from a numbers point of view, businesses that are more diversely run, businesses that have a more diverse makeup in their employee force are superior performers. McKinsey and Harvard have done research that has shown that those kind of diverse businesses outperform their peers by about 20%. That's no mean feat. And really, women across the globe are the main decision makers, purchasing decision makers in the home. In fact, over $15 trillion is attributed to decisions that are made by women. So if you are investing in a business that's not considering the tastes and preferences of women and how they make decisions, then you're cutting out on a big market. And so if you want economies to run at optimum level, to leverage all the assets, and women are seen as an underutilized assets globally, then you need a diverse population from the boardroom, ownership, through your company so that you can drive better decision-making, better corporate governance, and greater innovation, which will enable you outperform.
All right, so it's good to understand this. So it doesn't mean that whenever we talk about gender equality or gender whatever, it's just about the women. But for these facts you have noted, that's why we're focusing on the women for now. So what types of investments are feasible when we look at the Nigerian environment at this time?
Well, every type of investment is feasible because there's a lot to be done. At Alethea Capital, we make investments that don't just make a financial return, but also solve intractable problems that we have in our society. I've mentioned about financial inclusion. Energy inclusion is another one, enabling more affordable access to essential services. And so for us, we focus on that area where we can solve problems. And when we look across the economy, we find that when households and businesses do not have access to finance, it inhibits their ability to function fully or perform as a business. When they don't have access to energy, it inhibits their ability to grow and scale their businesses. When they don't have access to good health, well-being, that inhibits their opportunities. And in addition to essential services, when we think about access, we also address food security issues. And this is where we see the greatest impact, in a sense, on households and businesses, because the agricultural sector is the largest employer in our economy. And also you find that the smallholder stake farmers are the ones that are more challenged in being able to connect and get access to markets. So we invest along the agricultural value chain, particularly in the ability to provide a chain for those farmers to get their goods processed, to get their products into the market, and to enable us to avoid wastage. And I can talk about a couple of companies that we've invested in. So for example, there's a company called Tomato Joss in Kaduna that we've invested in.
All right, Tokumbo, I don't think really would like to go into that. But when you talk about, especially in the agricultural chain, being the biggest employer of labor in Nigeria, unfortunately, oil and gas is still the largest contributor to the GDP. So what that implies, I think, means that this value chain has not been explored enough. And you have a lot of women out there who have the creativity, who are ready to, and then you have the issue of funding, access to funding, the request for collateral, the home front business balance and all that. What about handling, some of these issues, access to funding, requests for collateral for women, so they can become more active in this agricultural value chain, which has a lot of unused potentials?
Thanks. And you touch upon a key point, because we tend to focus on this idea of collateral, which tends to focus on one type of funding. We need flexible investment structures. We need flexible types of funding that meet businesses where they are. When you have small businesses, they typically don't yet have the hard collateral that will enable them to take out debt funding. So is debt the best type of funding? At Alethea Capital, we provide equity funding that enables businesses to grow. We provide flexible equity, and we look at a business's stage and state. So stage, if it's still early stage, that means it needs more patient capital. If it's already generating cash, can we structure an appropriate instrument that will enable that company to grow? So when we're talking about do they have sufficient collateral, I think that's not the question. The question is, what's the best type of funding for each type of business wherever they are?
And we look at the Sustainable Development Goals, which is the target is 2030. How does this gender lens investment, how does it feed into the fulfillment of the SDGs?
Well, to be honest, what Gender Lens is doing is saying, let's build a more inclusive society. Let's build a society for inclusive prosperity. Let's leverage every talent that we have, and let's do that in the most optimum way by leveraging the dividends of diversity. And when you do that, then if you look at the SDGs, it's not just SDG 5 about gender parity. It's more than that. It's about reducing poverty. It's about increasing well-being. It's about partnerships. It really is about leveraging all the resources to reach optimum levels. So if I talk about how Gender Lens will drive SDGs, it's across all of them and has the opportunity to help economies like Nigeria reach those SDGs. Unfortunately, by not providing funding that enables us to be more inclusive on a gender front, that enables us to be more purposeful about mitigating the risks of groupthink and poor decision-making and poor governance, by enabling us to think more broadly about the products that will serve everybody in the economy, we are limiting our chances to achieve the SDGs. And it needs to even go beyond that. And I also want to say one thing, that it's not just about being soft and charity and achieving the SDGs, but it's actually enabling our economy to reach its full potential. McKinsey says that globally, that we can add 28 trillion to the GDP of the world if we fully leverage and consider gender, fully leverage all assets, including women at all levels, and factoring gender. Ergo, in Nigeria, if we're not doing that, in Africa, if we're not doing that, we cannot enhance our economies, we cannot reach superior GDP levels, we cannot reach full potential in Nigeria nor in Africa.
All right, thank you so much, Tokunbo Ishmael, Principal Partner at Alifia IDF. We will certainly push this conversation on gender lens investing and empowering, well, the women at this time, but of course, we need a balanced...
And the economy.
Yeah, of course, the women and then feed into the economy. Yes, of course. Thank you so much, Tokunbo, for sharing your thoughts with us this morning.
Thank you for having me.
It's now time for the market. The Thursday market, I think, made Will really happy. It was up. I know the day before it was very marginal. This time, it was no doubt the bull was out there, was charging in full force, and just put the wide smile on Will's face.
Yeah, this smile, it just can't stop right now.
Can't even talk.
I can't even talk. Because 0.55% up, that was more than I was expecting.
Okay, I think the last time we had something closer, that was last week when we did 0.7. I think we had that last
so week. This is actually from, you know, I felt like yesterday or the day before when they had a 0.01% uptick, I said it's more like they stooped low so they could leap higher, and that's what we have in the 0.55%.
So you're talking about going back. I mean, what's that thing? You charge back to get more energy. And
yes, that's basically what happened in the equity.
Will. I will remind you of this conversation.
Oh, yes, definitely. So the sentiment report yesterday showed that the NGX ASI had, 94%, buy activity yesterday, 6% sell. That's really, really, really good. And then we had money flow the money flow index was 86.57 points up. That's really good for the equities market and for investors. All share index, is at 48,837.76, nearing the 49,000 level, and the equity cap is at 26.328 trillion naira. Now, this was supported by gains in Seplat, which was up 9.1% yesterday. We also saw MTN Nigeria flying 0.9%. Now, the month-to-date and the year-to-date gains have increased. Now, month-to-date is now about 4%, and year-to-date now 14.3%. That is really, really great. Now, total volume traded yesterday was also up 759.64 million units traded, valued at 5.5 billion naira, and deals over 5,000 deals. That's the only decline there, but deals doesn't matter. Like one of our analysts said, volume matters in the equities market, and that's what we saw yesterday. FCMB was the most traded stock by volume and value. We saw about 503 million units of its share traded yesterday, valued about 1.7 billion naira. Now, performance across sectors was really phenomenal. All key indexes were in the green. Banking was up 0.86%. Consumer goods, 0.67%. Industrial, we also, it's having a hit yesterday. Investors were flying home, and MTN paid dividend out yesterday, so investors were pretty happy. And the market sentiment was positive. 34 stocks gained relative against 18 losers. So we moved to the bond space where it was a bit quiet. We saw a bit of repurchase for some of the papers, especially, activity. Traders were trying to reprice their assets and see what they can make from the secondary market after the bond auction on Monday. And in the treasury bills markets, only a handful of trades was successful there. But we have Caleb Alimi to talk to us about what, went down at the NTB auction on Wednesday. Good morning, Caleb. Alimi is a fixed income dealer at FSDH Merchant Bank. Good morning, Caleb.
Good morning, Will. Thank you for having me.
So, Caleb, tell us about the NTB auction. We saw further drop in yields?
No, we saw actually an uptick in yields. So at the last NTB auction, on Wednesday, we saw yield on the one-year paper rise by about 19 basis points from the last one a fortnight ago. We saw yields move up from 4.60% to 4.79% on the one-year paper. The 1.74, the 91-day and the 182 days remained flat at 1.74 and 3% respectively.
Okay.
The uptick in yield is due to a liquidity squeeze. It's due to a liquidity squeeze, which we expect that will continue into the month of May. We expect to see yields continue to trend upwards as investors continue to demand sort of like higher rates on the back of the large deficit budget that the federal government has to fund.
Okay, so we're talking about the liquidity squeeze. Yesterday we saw, did that affect the bond market? Because we're seeing rather like not so much going on there. Did it spill over to the bond market or any other segments of the fixed income market?
Yes, it did. It did spill over into the bond market. As you can see, the number of trades done quite low. What we also saw yesterday was due to the liquidity squeeze, we saw a bit of sell-offs on the short end of the bond curve. Before now, we had seen a lot of people pack cash, so to say, at the short end of the bond curve. But we did see a sell-off on that axis yesterday. For example, the 2025 paper, which was recently auctioned, auctioned at 10%, moved up to about 10.1% yesterday in the market. So we expect that to continue due to the liquidity squeeze, like I mentioned before.
So what do we expect looking into next week? Traders expecting, do we see this bullish momentum happening? Do we see continuous rise in yields?
Yes, we expect to see a continuous rise in yields. It's not a bullish momentum, it's a bearish momentum actually. We expect that to continue into next week. Like I said, the next week is a 3-day work week. Aside that, there isn't a lot of liquidity coming into the system. We don't expect much to change between now and next week. There are no major inflows into the market, except, of course, if FAC comes in today, that could improve the outlook of things. But between now and when FAC comes in, we expect yields to continue to tick upwards gradually.
So thank you so much, Caleb Alimi, fixed income dealer at FSDH Merchant Bank, for that insight. So, Ini, we have what is saying about the markets, but when we look at the NASD markets, yesterday was not so good for them. They had a 0.03%, downtrend yesterday, and we're hoping that they boost that market. But they are still at the 1 trillion naira mark for the market cap, and that's a good thing. Coming up all the way from 600 billion naira. That's a good thing for the market, is sustaining that. We don't know what's really driving it, but we hope that that continues until next week. So, Ini, we're going to be having public holidays for first 3, like Monday, Tuesday, Wednesday, but we'll see how Thursday and Friday will pick up.
First, that tomorrow, 7 p.m., we'll have capital markets, so you'll get more details about how the market traded. All markets traded, both the fixed income and the equities market. That'll be 7 p.m. tomorrow during capital markets. So please do join us then. Thank you so much, Will. We'll take another break. Now, when we come back, we'll head to London. Do stay with us. This is Business Morning on Channels Television. Welcome back. We head to London now, and we talk about Brexit. I think yesterday, or was it 2 days ago, we talked about Brexit being 80% contributor to inflation in the UK. Well, we're talking about another part now. We have Juliana joining us. Hello, Juliana. Good morning. Well, Brexit import checks has been delayed again. What's going on, Juliana?
Well, yes, this has taken port operators by surprise. Yesterday, the Brexit Minister for Opportunities, Jacob Rees-Mogg, told the House of Commons that checks on imports coming into the United Kingdom from the European Union that was supposed to be enforced now is going to be again delayed until the end of 2023. The minister cited the cost of living crisis and the war in Ukraine as a reason to why this is happening. Not good enough, says port operators who are considering putting up a legal challenge against the government because they have spent millions upon millions of pounds making sure that this border check infrastructure is in place for these checks. Now, of course, since Britain left the European Union, we're no longer in the customs group, and we also are no longer part of the single market, which means that goods must be checked. But there has been so many issues. Of course, the pandemic has exacerbated many of the bureaucracy challenges, and delays keep on happening. A couple of months ago, the government did put in £200 million to help private businesses set up this infrastructure. But according to industry experts, port bosses have spent a further £800 million. So 80 million pounds. So 100 million pounds in total has been spent. I do actually have a statement here from Richard Ballantyne, who's the chief executive of British Ports Association. He's responding to that statement that was made in the House of Commons yesterday by Jacob Rees-Mogg, saying this is quite an amazing development, to say the least. Many UK port operators have built border control ports in preparation for these post-Brexit border checks, and they're due to be ready. This announcement is a major policy change, meaning the facilities will effectively become white elephants, wasting millions of pounds of public and private funding, not to mention the huge effort there has been to get things ready in time. So a row is brewing, talks of a legal challenge. We'll just have to wait and see if there's a statement to be made from Jacob Rees-Mogg or indeed the Prime Minister Boris Johnson.
Yeah, Juliana, well, this Brexit, adjusting to the changes that comes with Brexit, seems a long way from being over. That's just what it looks like. Well, let's talk a little bit about corporates now. We see NatWest posted a 41% jump for the first quarter, and that's some good news in the midst of all of this.
Yes, absolutely huge. We are right in the middle of trading, Q1 trading updates, and NatWest has become just the latest British-based big lender to announce their profits for the first 3 months of the year, and they've taken everybody by surprise. Banks in the UK have suffered since the pandemic because, of course, with historically low interest rates, profitability has shrunk, and, of course, there were so many of these loans given out by the government. A lot of banks had to put aside millions of pounds in impairment payments to make sure they're covered if these consumers were not able to pay back. And NatWest have completely bucked the trend. They have reported a 41% increase in profits in the first 3 months of the year. It's jumped up to £1.25 billion. This time last year, they were reporting £785 million worth of profits. Now, Alison Rose, who's the chief executive, she's been speaking to British media, and she's been citing the rise in interest rates, currently at 0.75% here in the UK. We are expecting the Monetary Policy Committee, when they gather in Threadneedle Street next week, to perhaps raise interest rates even further to about 1%. But yes, you know, this is a payday for investors, as they would say. NatWest hasn't been doing so well in the past year. I think their share price is probably down about 20%, but of course, no surprises. They're leading the UK blue chip index risers with this announcement made earlier this morning.
Yeah, payday indeed for them and investors of NatWest. Well, we'll see how other lenders, especially with the expected hike in interest rate next week. Juliana, thank you so much. We'll talk to you at 1:30.
Thanks, Ine.
Well, without a doubt, I know it's a red Friday and not a lot of, unlike Will, not a white smile on Laddie's face this morning.
Well, I have a smile, but, you know.
A little one, just a little one.
Just a little smile, you know, but it's still extreme fear, you know, in the crypto space. We're seeing, you know, major markets globally have a tough April, but it was good for the NGX, you know, which is good. But the crypto market is still extreme fear at 23 points, moving deeper into the fear region. Market cap $1.81 trillion, that's up about 0.30%. We see volume traded up about 17%, and Bitcoin dominance sits at 41.59%. And we see Bitcoin did try, you know, relief rally to get to about 40,000, but it had a pullback this morning down about, it was down just a little there by $39,490. It's up at 8 a.m. at 0.21%. Volume traded $35.08 billion. And we see Ethereum also holding up, trying to get above that $3,000 mark there. It's up 1.23%, and we see volume traded 19.14. And checking out the top odds by market cap is just BNB in the green on that counter. That's up about 3.66% at $405. And we have XRP at 64 cents, Cardano 83 cents. So it's kind of a mixed bag we're getting this morning in the crypto space. But there's also conversations right now about, you know, blockchain scalability and transaction times. Well, having right now joining us Richard Paris, co-founder Saito. Great to have you, Richard. Good morning.
It's really good to be here. Thanks, Laddie.
Yeah, so we've been hearing about, you know, blockchain technology for a while now, and that has evolved into a lot of things from play to earn, the metaverse and all of that. But there's still issues, you know, with scalability, transaction speed, decentralization, and security. What for you are the solutions to this trilemma?
I think for us, it's really fundamental. So the Saito opinion is that things like the scalability trilemma aren't necessary facts about blockchains. They're actually just an artifact about how we've designed blockchains up till now. And I think, you know, the industry has made such strides so quickly along with the technology that people haven't necessarily stepped back and really thought through what we've learned and what we can see about these problems as they manifest in reality. And our solution is to really think through blockchain design in a way that aligns incentives for all the players in the system, such that these things actually are undone by design rather than by trying to fix the existing designs.
You know, obviously, globally at some point, let's take for hypothetically, you know, at some point, the whole world, you know, catches on with this whole, you know, blockchain technology. Would the blockchain be able to handle global adoption?
Not the ones that we're seeing now, and I think that's a key thing. So I think we'll continue to see some of the innovations in the space. The EVM that Ethereum brought to the industry will continue, I think, forever to be useful for things like tokenization. There's a whole lot of things, NFTs and, you know, simple securities and things you can build that way and in brand new ways we couldn't do before blockchain. And I think public key infrastructure that Bitcoin brought to us, that'll stick around. But in the future, finance, the kind of things we see blockchains doing now, will probably be about as much of the blockchain space as finance and money is of the full internet in general, which means we've got a huge way to go to make up for the services and the bandwidth and the scope we need to really support that globally.
Yeah. All right, Richard Paris, it was great having you, co-founder Saito Network. It was great having you on the show today.
Thanks, Laddie.
All right, so let's look at the top 5 gainers. We've seen, it's a mixed bag. We're seeing a couple of double-digit gains, but we see Nexo there topping that counter up 15%, and we see ApeCoin still trending up. ApeCoin has had an incredible first quarter since launch. It's trading at $21. This started trading as low as $1 just a few months ago, but it's had an incredible run this month, and we're seeing ZRX topping the losers counter. That's also started an uptrend from the 60-cent range trying to stay above the dollar, but it's at 79 cents, down 13.46%. So, Ini, that's the market today.
Thank you so much, Ladi, and we do wish you a green weekend, unlike last weekend.
Hopefully there's a green weekend.
Well, that's it on the program, but we'd like to remind you that Channels Television does not trade in cryptocurrency, does not advertise cryptocurrency. All we do here is report the market. So if you bump me to any platform, anywhere, with a Channels Television logo telling you to trade in crypto, it's false, it's fake. Just put it out there. It's fake with a red sign there. So we don't trade in it. We don't advertise. We don't have any business except to report, which is our major work here on Channels Television. That's where we draw the curtains for the week on Business Morning. Monday will be fresh and a full episode for you. So to join us at 10 a.m. But before then, 1:30, we'll have Business Incorporated. And tomorrow, 7 p.m., we'll have Capital Market. So it's a loaded one for us from the business desk. Do join us for all of that. I'm Ini John McQuad. Enjoy your weekend and the holidays ahead.